Hi there, welcome to Winning Today. My name is Lunta Di La Paulo. I'm the founder of Yeto Accounting and Tax PLLC. Today we're gonna be looking into customer analysis. Okay, in this video we're gonna help you better understand your customer base. You'll gain deeper insight into how well you know your customers, right? You'll determine things like how profitable are my clients, who are my top 5 or top 10 clients, for example. You'll also understand what's the cost of servicing certain clients and whether or not you should be continuing servicing certain groups of clients versus others, right? You'll understand, you'll also find tools that will help you determine the value certain clients bring or not bring to your firm so that you can make better and informed decisions about your client base. Okay, usually when we look across a digital marketing agency firm, usually they have a workbook or whatever resource they use to keep track of their client. They'll have these six pieces of information, right? The client name, the employee covering that client, the revenue the client brings, and the percentage of revenue these clients represent, the service you're providing to this client, and then the geography where this client come from or it's based. Okay, with this information, which is a good start, by the way, with this information, you can easily determine things like who are your top 5 or top 10 clients. Easy. You can determine what percentage of revenue these clients bring, right? You can also determine how much revenue each service provided bring or what state brings the most revenue and so forth, right? But this is a very limited understanding of your client base, right? Because one client may bring a lot of revenue, but might cost you a lot more to service that client, right? So you need to figure out a way to determine the cost associated with each client. Do you understand? Okay. So if you have a client that it's costing you more money to service them that than they are bringing, maybe you should ask yourself some serious question, right? So that's why we use the ABC methodology to help understand more our clients, right? So ABC means activity-based costing, right? So it's an accounting methodology used to determine the cost and profitability of a given unit, client, or service, and so forth, right? So, for example, for this client one, our variable cost, which is the cost that only exists because of the revenue we're obtaining from a client, right? If we didn't have this client, we wouldn't have incurred this $3,000 in costs, right? So this helps us understand, okay, how much it costs us directly to service this client. And we can see some of these clients actually it costs us more to service them, right? Evidently, any business owner would ask themselves, okay, what can I do maybe to increase the revenue that I'm bringing from this client, or should I maybe just get rid of this client to open room for better clients, right? And I understand there are clients that we enjoy working with them and we're not gonna fire them despite the low revenue they bring to the firm, okay? And then we get our contribution margin, which is essentially subtraction of variable costs from revenue, okay? But that's not all that we need to look at, right? We also need to allocate the cost of our employee who oversee that account to that specific client, right? There is a proper way to do that so that we're not over uh, assigning costs to one client versus the other, right? So that's very important, very, very important. Once we do that, we can see that some of the clients are actually losing us so much money, right? And we also see what clients are really delivering stellar results for the firm, right? Anything over 70, 75%, it's decent in the digital marketing space, right? In terms of profitability. Any client below 70%, we might try to figure out, okay, should we find ways to increase our revenue and maintain our costs where they are to service this client? Or should we allocate less resources, right? So a lot of these the clients actually below 70 are, below 10,000, right? So that's a really an important question we should be asking ourselves, right? So after I do that, I'm in a better position to answer better questions, more than just understanding the revenue of the firm. Now I do also understand the profitability of the client in the firm, right? So therefore the customer profitability analysis. But I want to give you a little bit more of the gift of the analysis we offer here, right? So that you can better understand your customer, right? This is great, but that's not all. Now, the other thing I really want to understand is when you create a budget, a forecast, a projection, or estimate for a given period, we really want to make sure that that revenue projection, right? That revenue projection is tied up to our client base, right? So, for example, if we are expecting that this year some of our clients are gonna do very well, and therefore they're gonna increase the demand of our product, we want to increase, right, the expected revenue we want to see from them this year. But for clients struggling or maybe looking to close their business, our expectation is that we're gonna decrease how much we expect to get from them. If you're not doing this kind of exercise, your projections are really in a vacuum, okay? So you really need to do better. So, for example, for client one, we are expecting a revenue of 25,000 from this client. But it ends up happening that we received 40,000 from this client. Therefore, we have a 37% positive variance from this client, right? We had 15,000 more revenue from this client than expected. Even though it's a good variance, we really need to ask ourselves some question: why, right? Why did we get more revenue from this client? Was it an increase in price? Was it in more services we delivered? Did they buy new services, and so forth, right? But the more concerning ones are negative variances, right? Why did we make less revenue than what we're expecting? So look at client number 6, for example. We were expecting to generate 30,000 from this client, but only came in a little over 23,000, right? We're short over 6,000, therefore a negative 27% variance, right? What happened in this in this client's business? Are they shrinking? Are they reducing their advertising budget? Are they at the peak of their existence and therefore they're no longer interested in expansion and so forth, right? What is happening, right? And then we do an extra layer of analysis, trying to understand clients who are at risk of loss. What's the possibility, the probability of losing a client? Is it high, medium, and or low? Right? For any client that I respond to no, right? I have a high confidence that in the foreseeable future, they're still gonna remain in the firm. We're still gonna be generating revenue from them. Therefore, compared to the lifetime acquisition cost, I'm still in a good place with this client. But for any client that I say yes, that the risk of losing them is very high, right? I need to figure out, okay, can I live without this client? Can I let them go? Or are they the type of client that if we lose them, we're gonna be bleeding 5-10% of our revenue, right? And make sure that that's not gonna happen, right? So that's a very critical point when we conduct our analysis. And then the last piece of our analysis is customer rating, right? We love rating clients A, B, or C, right? Just like in school, A students are loved by their professors. They receive the praise, the awards. They are in the dean's list, president's list, and so forth, right? In our business, we also need to understand who are our star clients. That if they call even after business hour, we're still excited to service them, right? And we figured out that at least when we work with client, we have four criteria that we analyze clients, right? Number one, the level of revenue they bring to the firm. Is it equal or above the average revenue of the firm, right? Clients who are above receive 3. Clients at the average revenue level receive 2. And clients below the revenue receive 1. It seems like this example client has a lot of 1, right? Enjoyment to work with client. Is this the type of client that gives pleasure to your staff, to my staff to work with? Or is this a pain to work with? Is this the type of client that causes a lot of problem to the firm? Is it the client that could even present reputational risk because we're working with, right? So we also provide, right, a rating here, right? And then timeliness to pay, right? Do they pay upfront right away when we receive the invoice, or are they the type of client that wait 30 days before they pay, or they pay past the due date to pay? How effective these clients communicate? Are they good in communication? Do they deliver the information, the data we need on time? Or are they the client that take their time, they don't bother? We have to go after them 3, 4, 5 times before they can give us the information, right? This piece of information, then we create a formula to give us a rating that spits whether they are an A client, a B client, or a C client, right? Once we have this level of intelligence, right, we are in a better position to make decisions about the type of client we want to work with, right? Now we really do understand our client base. We know who are our profitable clients, where they live, who are they, what they're buying from us, the level of profit they contribute to our business, how good they are in communication or not, how well they pay, right? And the pleasure they give us in working with them, right? The type of clients that have essentially become part of our business, and therefore friends and family in a way, right? Or are these the type of client that we should really consider firing because they're going to continue being a blockade for our future growth? Yeah. So that's really the goal of this exercise that we just did in our Excel workbook. Now, let's move away from the 100 pages, okay, or 100 rows in our Excel, to look in a cleaner manner, right? So let's look here. This is a summarized way. By looking into this, our clients usually understand the most important facts about their client base. They know that their top 5 clients contribute 24% to their revenue, meaning it's not risky yet. But also we know that from the summary we have here, none of the client contribute over 7% of the firm's revenue, which is great. Only 2 clients contribute between 5 to 6% of the revenue, right? So less customer concentration risk here, right? We also know that Jane is the client that services most of our clients, accounting for 60% of the revenue generated, right? $1.9 million, 1.09 million, excuse me. And then we have revenue from state. Which state contribute the most revenue? Should we expand our effort into the states where we have less revenue, or should we spend more resources in Michigan and Illinois where we are already doing very well, right? And then our top 5 clients, right? You can also put there your least or your bottom 5 clients, right? And then you have your customer rating here. We know 66% are B clients, 32% are A clients, and then 2% are C clients. This gives us a little bit more confidence in terms of our client base. The goal should be moving B clients into A and C client to B at least. Okay? So with this, I don't want to make this video longer than it already is, right? I hope you gain valuable information to help your firm move forward, right? Our promise this year is to make your business more profitable, help you manage better your cash flow, and help you reduce your taxes. If you'd like to hire our firm to do the analysis we ran here, feel free to give us a call or send us an email. We'll be there to help you achieve your goals, okay? So I'm gonna pause here, and please let us know if there is anything we can do to help you.